We now come to our final part under the Wealth Management Unit 4 and talk about one of the integral parts of wealth management as an industry, which is the ethics code that should be a part of the wealth industry. Now, while there is no real rule that stands around this, and regulations do specify for some minimum standards, in our opinion, what is going to change in the long run is this specific portion of how ethically a wealth advisor or wealth manager behaves or conducts himself or herself in this industry. So the way this has been defined is we have defined it in terms of four major pillars. And how do we look at conducting ourselves as wealth advisors or wealth managers that ensures that the best interest of the client is kept in mind, right? Remember, this is the key to the entire discussion around wealth management, ethics in wealth management. Given that we know the structure of the industry is such that there is a distributor or advisor, and in the context of a country like India, these terms are used interchangeably to a large extent. There is a client who's the investor, and there is a product manufacturer, correct? And we have already seen that this creates a skewed structure where the client gives money to the distributor, which then gets invested through to the product manufacturer. The client essentially pays a fee to the product manufacturer, which gets passed on to the distributor. So practically, there is a commission that is paid here, and that distorts the decision making for the advisor or distributor, or historically has done that. It's not to say that all advisors do it, but it's just that the structure ensures that there is going to be a skewed loyalty in this case. And hence, it is important for the advisor to ensure that the structure changes to something like client plus advisor, and the advisor is basically on the side of the client advising the client, and then these guys are dealing with the product guys, right, which is one entity. And hence the payment of the fee has to happen directly from the client to the advisor. That makes life easier, right? uh, that's how regulations are moving, that's how technology is moving. And given these pillars, what's going to happen is eventually the advisor will be under a greater scrutiny unless the advisor chooses to conduct himself or herself in the most ethical manner possible, right? So let's understand what are the key responsibilities that an advisor has. And then we basically go ahead and look at some of the key pillars of how ethical conduct can be done, right? There are a few responsibilities of investment advisors. The first one amongst them would be essentially around conflicts of interest, right? So an advisor has to disclose all conflicts of interest to the client as and when they arise. For example, if the advisor is asking client to take in a particular fund, then advisor should also tell whether he or she has a position in the same, right? Or what is the kind of arrangement they have with this setup, right? Or if, let's say, the advisor's spouse works in a certain firm, and let's say the client wants to open a bank account, right? And the advisor is there whose spouse works in a certain bank, let's call that bank A. If the bank account is opened with bank A, it is the responsibility of the advisor to disclose that his spouse or her spouse works in bank A, right? So that conflict of interest has to be clearly told. Segregation, which is an arm's length relationship, must be maintained between the investment advisory activity and other activities. If conflict of interest arises, the same shall be disclosed to the client. Example, earning advisory income from the client and earning distribution income from the AMC or asset management company. So if you're earning advisory income here and you're earning the commission here, you have to disclose both of these ideally, right? And you have to segregate the two. which basically means that technically your advice has to be independent of the commission that you're getting. You might get the commission because the structure allows you to get it, but the advice has to be independent to that, right? Confidentiality. Information related to the client is confidential. Utmost importance has to be given to this, that it should not be disclosed to anyone by the advisor without permission, even if it is in the interest of the client. Ideally, so for example, let's say the client mentions that I want to buy a plot of land, and this information about the client is given to someone who's willing to sell or a broker who's dealing with real estate advisory. It might be good for the client in the long run. The client might be happy about it because the client ends up buying a plot of land. But the reality is, unless the client says so, the information should not be disclosed. Confidentiality in financial services is a big issue. People end up giving out their detailed bank account statements from, details around bank accounts held with a certain bank. These get disclosed a lot of the times to other bankers as well. Because we do have informations or incidences where client holds an account in bank A but gets a call from bank B saying that why don't you also have an account with us. So surely there is a leakage of information somewhere. As a good wealth advisor, it is of utmost importance that the confidentiality of the client information is maintained. That is that is imperative in this business. Then there are a few more responsibilities. So KYC compliance. An investment advisor shall follow the know your client procedure as specified by SEBI from time to time. So the KYC has to be kind of followed. You need to know the details of the client, where is the money coming from, etc. That's more adherence to your responsibilities as an agent in this entire thing. You have to report to SEBI and auditors in case that is required. Now that's basically SEBI has come up with SEBI registered investment advisors. If you are an investment advisor, you have to anyway file periodic reports and information to SEBI as may be required, right? SEBI also ensures to the quality of people who are dishing out this advisory. So there is a responsibility of the investment advisor to ensure that representatives and partners comply with the certification and qualification requirements. So basically on the knowledge front, you cannot be sending someone as a wealth advisory firm to deal with the client when you don't know what is the knowledge capability of the advisor, right? So these regulations have to be kind of kept in due account. These three are typically more on the regulatory front. The first three that we saw were more on the advisor's understanding of the client data and how does the advisor go about looking at that data. This allows us to segregate the ethics part in four broad pillars, right? So trust, information, suitability, and disclosures, right? Trust, since you are dealing with money, unless you have established yourself as a trusted person, clients will not be comfortable with you. Information, in this age of information overload, it is your duty as a wealth advisor to segregate garbage information and give the clients correct information, right? So you have to remove the noise from the relevant information. Suitability, you should act not what client says, but what the client is suitable with. Remember, you are the person who is aware. The client may not be aware. So the client might say, I want to invest in stocks, but if it is not suitable for the client, you have to act accordingly. You're like a doctor to the client, right? Disclosures, you should not provide partial information to clients and influence decision making. A lot of the times, information around specific funds is not completely given. You only give the part of the information which is likely to get you the business. That is incorrect. Disclosures have to be complete, right? We'll divide these into these four pillars. We'll take them one by one. Again, remember, this is just what we have kind of collated. It is important for a wealth advisor to follow this. It's not a rule book that is available at this point of time. This is more a code of conduct that you have to follow as an advisor should you join this industry as an advisor, right? Because that's what differentiates a good wealth manager or a wealth advisor versus a pure play commission agent, right? Pillar one, trust. An advisor shall be prompt in disbursing dividends, interest, or any such accrual income that it receives on behalf of its clients' investors. In case there is an arrangement where the advisor is getting some of this income in his or her account, there should be promptness in disbursing this, right? Most of the times, clients don't have their accounts with advisors. They have their individual accounts, so money comes directly to their accounts. But in case there is such an arrangement, it should be done promptly. The advisor should refrain from indicating or assuring returns in any type of scheme unless it is explicit by the product manufacturer, right? Unless the product manufacturer is willing to give it in writing that there is a guaranteed return, you cannot use this. I mean, technically, you are not supposed to use this, but in practical sense, a lot of people say guaranteed 8%, guaranteed 9%, guaranteed 15% return kind of a thing, right? A lot of the times you don't guarantee it, but you indicate it as such, right? Which basically is a statement like invest 5,000 per month today in a certain plan and get 20,000 per month after 20 years or after 10 years, right? Now, there will be a small star, which will be a terms and conditions apply, which will say that you're assuming a certain rate of return, which may or may not happen, right? Technically, this is not allowed. Ethically, this is obviously incorrect because you're giving an incorrect picture. So you cannot indicate any returns unless explicitly mentioned by the product manufacturer. You can guide saying that, okay, bonds give about 6-7% return, equities in long run give about 12-13% return. But you also have to outline any kind of possible ramifications of investing in equities, right? Negative ramifications of investing in equities. Refrain from making negative statements about any AMC or scheme and ensure that the comparisons, if any, are made with similar and comparable products along with complete facts, right? So you should not badmouth one AMC or give unfavorably a lot of unfavorable response about one particular AMC unless there is reason to believe with facts, right? Advisors shall not pass back commission to investors. This is as per the rule today. You cannot pass back the commission to the investor. Although if the rule changes, then you can take a choice around that in terms of real world. You should abstain from attracting investors through any kinds of temptation of rebate, gifts, etc., because you're not acting in the best interest of the client. You should never sign any form on behalf of the client. The client has to sign it himself or herself. That's pillar one, trust. Pillar two is information. You shall act honestly, fairly, and in the best interest of the client, and by providing all information that is relevant. Correct? So if there is a product, you have to give all the information, good, bad, ugly, whatever the information is, you have to give it. An advisor shall seek from its clients information about their financial situation, their financial investments at this point of time, and experience and investment objectives relevant to the services and maintain confidentiality. So you have to get what kind of goals are there, what is the current situation, what are the loans, what is the goal, where will you invest money at some point of time. All this has to be kept in mind, and you have to maintain confidentiality of such information, right? An investment advisor advising a client may charge fees subject to any ceiling, as there might be via regulatory authority. You can charge a fee, there's no problem around that. You shall ensure that fees charged to the clients are fair and reasonable, right? Just because you can make money, you cannot go ahead and charge whatever you want on a certain area. All source of income should be disclosed to clients before any kind of investment in any form or products, right? An advisor shall not increase charges, fees for the services rendered without proper advance notice to its clients, investors. Ideally, that shouldn't happen. And again, there's no rule around it, but it's better not to give negative surprises to clients. Advisor shall not make any misrepresentation and ensure that the information provided to the clients investors is not misleading. You have to give complete information. In addition to complete information, you have to give information that is not misleading and there's no misrepresentation, right? So effectively, that has to happen when you're looking at giving out information in the form of ethics. Suitability is the pillar three. Investment advice and investment should match the client's risk profile, right? So is the client uh, a good client to be recommended a certain product? Is the product suitable for the client? Has to be judged by the advisor. The client may not be aware to make that decision. The advisor should have a documented process before executing any investment. Why is that necessary? So that the suitability is not missed out. There is an objective test of suitability for every investment, right? Tomorrow a new fund comes in that is, let's say, a small cap fund. It may not be suitable for someone who's 75 years old. This check of suitability has to happen, and there needs to be ideally a documented process which tells that, okay, once a new fund offer comes in, I have to check with all my clients whether this makes sense. I have to evaluate on the basis of all my clients' data whether this is suitable for them. And if it is not suitable, I shouldn't go and recommend it to the clients. Similarly, if there is an insurance product and you have a 60-year-old client who has already made enough money, remember there is no financial implication of loss of life in this case because there is enough money and savings that has already been generated, right? In that context, insurance may not be necessary. So suitability has to be checked very clearly before recommending a product to the client. The advisor must understand the nature and risks of products and assets selected for clients. It is important that we ourselves as advisors understand each product and the risk associated with it. The advisor must have a reasonable basis for believing that a recommendation or transaction entered into directed towards meeting any specific goal, and the client understands the risk involved. So effectively, when you do go and do an investment, the client should understand if any specific goal like child's education or retirement fund planning is being met with that in mind, and the client understands the risk that is involved there. It's not just that I should understand as an advisor what is the risk. It is also an idea that we should probably try and educate the client with respect to what is the risk there. So the client understanding is a process of education of the client. From time to time, we should try and ensure that all clients understand what kind of risks are entailed in any kind of investment that is being made, right? That's the third pillar. And the final pillar is disclosures, where all sorts of information that is available has to be disclosed in the best possible manner. It is the responsibility of the investment advisor to make certain disclosures to the client in order to the client to take an informed decision whether or not to avail its services, right? So the advisor has to give all sorts of disclosures. Where is the revenue coming from? Where is the money coming from? What kind of affiliations I have? Performance track record in the past has to be made so that the client can make an informed decision, right? Information about the advisor, the business, history, terms and conditions, affiliations, etc., with respect to other intermediaries has to be disclosed. Consideration received from any distribution or execution services for securities or products for which this is provided, you have to disclose commissions. The rule doesn't say that. It's a good idea to do that because the client then is more trustworthy. The client believes you're more trustworthy in the entire process. It's a good idea to say that, look, we make commissions out of this. Remember, it is difficult to practice a lot of this in real life because of the existing structures, but nevertheless, it is important that this is disclosed when clients are looking at this data. You should also disclose if there are own holdings in respect to products or securities that are subject matter of advice, which is if I am recommending a certain product, have I also invested in that product, right? Any actual or potential conflicts of interest with the issuer of product or security, which is any kind of relation, what kind of fee, what kind of arrangement am I getting from the product manufacturer, has to be clearly specified. For example, if I sell 10 insurance policies, I get a bonus trip to Singapore. I need to disclose it. I first shouldn't be taking it in the first place. And if there is any such arrangement, that has to be disclosed. Material facts relating to key features of product securities, performance track record, warnings and disclaimers, and advertising material has to be clearly specifying all sorts of disclosures around all these specific items. So we go back to our previous discussion on why this is important. Remember a couple of things that it is not mandatory that someone follows these ethics standards. It is good if we follow this because that's what the client expects us to do in as a wealth advisor. It is difficult to follow it also because in the current structure, the way the wealth management industry is kind of built, there's a structure where the payment happens because of the product manufacturer, and hence there is a skewed incentive structure that is in place. It is important for us to believe that this can change at some point of time. Regulation, technology, and awareness is going to change it. It is difficult to directly go and implement all of this in a firm that is already providing wealth management services because they themselves may or may not be following all of these, right? This is a boundary condition of the code of ethics. Ideally, as an individual, we should try and practice it as far as possible. And wherever there is a breach that is happening, we have to always decide that client interest is paramount, right? Client interest is paramount. We should not be mis-selling any product at any point of time to the client, irrespective of what the organization wants us to do, right? It is important for us to be convinced about what is being advised or sold to an investor, and that will only happen if the highest standard of ethics are followed. Remember, once again, I'll reiterate, it is not easy to implement this in the real world because real world works on certain set structures, and these structures are changing as the industry is evolving. A lot of the firms, even today, do not discontinue with the malpractices that have existed in the past. And so there is a fair chance that you might encounter some of this in case you end up working in any of these firms. But it is our responsibility as advisors to ensure that this changes in the next few years so that the industry itself becomes a good and better place to work. And people trust financial advisors more in the overall scheme of things. That's broadly it in this particular section on ethics. Very quickly, as we end this, a couple of questions. Briefly mention the four pillars of ethics in wealth management and explain why ethical practices are necessary and difficult in today's wealth management industry. Thank you.